My name is Mark. We're talking about making consistent money or an income that we can rely on. Then everything changes about this. Everything changes. What I'm talking about here is I'm talking about these like 5 or 4 broad skill sets to be able to create consistent results, the kind of results that you can rely on as an income. You're going to have to learn an edge. You're going to have to acquire a trading methodology that gives you an edge. I'm defining an edge as that there's a higher probability of one thing happening over another. That's what an edge is. We're going to learn the nature of probabilities here in a moment. You're going to have to have, you're going to have a plan on how you utilize that edge, meaning what the risk is, position size, and profit objectives. Then you're going to have to be able to execute. You're going to have to get to the point where you can execute that edge without making errors. For you to be able to execute that edge without making errors, you're going to have to learn how to trade from a carefree state of mind, meaning you're going to have to aspire to the point where you can trade without fear. And to trade without fear, you're going to have to learn how to think in probabilities. That's basically where we're going here. When I said this primary skill was learning how to trade without fear, learning how to trade without fear is a function of learning how to think in probabilities. Meaning we're going to set aside or move from thinking in a trade-by-trade mentality. In other words, what this trade is going to do for me right now, am I right or wrong on this trade? And we're going to move to a series of trades perspective, because that's what your methodology does anyway. Any trading methodology just gives you a win or loss ratio over a percentage of trades. In other words, if I take the same criteria that's in any kind of any kind of technical formula that's mathematically based, or a technical price pattern that you would be able to see visually, what we're going to learn is that my edge, meaning a higher probability of one thing happening over another, is simply going to give me a higher win rate over a series of trades. Let's say the next 20 trades. 1, 2, 3, 4, 5, 6, 7, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. And that the actual, on a trade-by-trade basis, I don't know which one's going to win or which one's going to lose in advance. There is no way for me to find out. There's no way for me to determine that. That on a trade-by-trade basis, no matter what reason or rationale that you come up with, is that there's no way to assure yourself that it's going to be a winning trade. There's nothing that can tell you that. That trading methodologies give you a win percentage, let's say 70% of the next 20 trades are going to be winners. There's no way I'm going to know which of the 70, which 12 or 13 are going to be the winners, or which 6 or 7 are going to be the losers. What you're going to learn, and this is what the professionals have learned, is that there's a random distribution between wins and losses over any given set of criteria that define your edge. There's a random distribution. I will get a higher percentage of wins to losses, but I just don't know which trades are going to be. It requires a complete shift in the way you think about trading. When you make this complete shift, everything about your trading will change. Now, I'm expecting you to make it now because we're still in the introduction. We won't really get into the meat of this until a little bit, but this is where we're going. Okay, that's all I want to get. This is where we're going. You're going to genuinely learn how to think in probabilities, because when you have genuinely integrated these concepts into your mental system at a functional level, your fear will go away. You do not need to lose everything to get to the point where you can figure out that, well, I've got nothing to lose anymore, so I don't have anything to be afraid of. You don't have to do that, okay? You don't have to do that. All you have to do is commit yourself to learn how to think about trading in another way, and your fear will go away. Because what we're going to learn is the correlation between what we believe and what we feel. There's a direct correlation between if I'm going into a situation with a certain belief that, let's say that my particular edge is going to tell me what's going to happen on this trade right here, I wouldn't even put this trade on unless I thought it was going to win. When you really understand the nature of price movement, which is what we're going to get into after we go through this section on skills, when you really understand that, you will never think that way again. When you really understand the nature of price movement, you won't think that way again. And that is one of the biggest problems that the typical trader has. Let's say the typical screen-based trader is that they really don't understand the nature of how prices move and the underlying dynamics, because you haven't had the exposure. You haven't had the exposure to the direct markets. Your only exposure has been those blips on the screen. And as a result, there's a real gap in understanding about what's really happening. When you understand what's behind those blips, what's behind those photons that show up on your screen, when you really understand that, you will think about trading in another way, in a completely different way. It won't even occur to you to do some of the things that you're doing now. It won't even occur to you. Okay, now, I've given you 3 so far. The next broad area that you're going to have to learn is like you can be an expert at defining an edge. You can even be able to execute your trades flawlessly, but run into the next challenge, and that's what I just call self-sabotaging beliefs. In other words, all of us have a sense of self-valuation. All of us have this sense that what we're worth as a person, you might say. And if you were to take like an old Ben Franklin accounting scale, okay, and this is positive and this is negative, meaning if you were to list every experience in your life, if you had, let's say, conscious access to every experience in your life that contributed to a positive sense of self-valuation, that yes, I am a worthy person, because what we're running into, I kind of got ahead of myself, what we're running into is this, is that when you learn how to define an edge and learn how to execute your trades flawlessly, what you're now exposed to is the possibilities for unlimited wealth. There's really nothing holding you back. Well, let's put it this way: there's nothing on the outside that's holding you back, but there might be something on the inside that's holding you back. Those things on the inside could be self-sabotaging beliefs, in the sense that if you listed all of the experiences that contributed to a positive sense of self-valuation and all experiences that contributed to a negative sense of self-valuation, that I'm not worthy as a person, I feel guilty about this, and this, that you could end up, you can go plus negative, or net positive or net negative. What could end up happening is that if you don't have the, let's say, the skills or the awareness to realize that as your equity curve, as you start making money, these internal forces, if you have net negative, these internal forces start building up to the point where they'll cause you to make unconscious trading errors, where you're not even really aware that you hit the sell button instead of the buy button. Those kinds of things. And you have to become aware of when these forces are starting to build up inside of you, and either compensate for it by not trading, to stop trading, or to find a way to neutralize them. And there are various techniques available. But all I'm saying is that these kinds of errors that are the result of self-sabotaging beliefs don't really have anything to do with your direct trading skills. In other words, your ability to identify an edge and your ability to execute your trade. But they can have an enormous impact on your equity curve.
I would assume too that you would be monitoring your equity curve. You would start seeing your curve go down in an abnormal way, and you would start looking for your whatever's happening to you. Let's say you're not feeling well, or whatever. Your wife just divorced you. Or maybe
yes.
something.
Yeah, these are all good things, right?
Things
that you're bringing up. I mean, these are things.
What I'm saying is, though, you show two extremes: a normal drawdown, and then the boom or bust drawdown. There must be some way to know. At least I'm looking for to know when you start looking that you're self-sabotaging. That's my question.
Good question. As a matter of fact, there are software programs available now that will tell you that. There are software programs available that will tell you when, in other words, I'll give you an example. Give you an example. When I was working with traders, with especially like hedge fund managers and larger traders, there are people. First of all, there are people that their sole job was, if they were, let's say they were central. Here, let me think about how important this is. They had, let's say, they're in the middle, and they've got, let's say, 10 or 12 money managers. These are guys that all have, they're managing funds, okay? This guy's sole responsibility was to shift money from here to here to here to each manager based on chart patterns of their equity curves. In other words, they would chart the equity of these particular traders, just like price patterns in the market, to determine their potential for inordinately large drawdowns because of self-sabotaging beliefs. That's how sophisticated the market has become. That's how relevant these issues are. So that you can actually chart your equity, and then you start to go like this. Oh, and then do another one like that. Something's happening here. Okay. I mean, it was really kind of amazing to me when I was working with floor traders, especially. I mean, this one guy, this pops into my brain just as we're talking about this. I mean, he came in for a consultation, and he had his worst day in his life ever. Worst trading day, lost more money than what he's ever lost in his life. And I said, well, and it's like normally, almost virtually in every case, something catastrophic's happening in that person's life. What was always amazing to me is how much of a disconnect that the person would have between the catastrophic event in their life and what they ended up doing as a trader in the market. And I said, well, what's going on? And I just said, well, what's going on? And he's kind of, well, yeah, my wife and I had this really bad argument last night, and when I left for the exchange this morning, he slapped his kids around and he kicked his dog, and it's like, and then he came in and had his worst day and didn't make the connection between what happened at home and what he did on the floor. I mean, he might have felt completely justified with the argument that he had with his wife in slapping his kid around and kicking the dog, but that's what's going on consciously. But let's say subconsciously, everyone has, let's say if a person's relatively normal, not a psychopath, they've got some sense of fairness, and he feels guilty about what he did, and he took that guilt out in the way he traded that day.